I think that's probably as attractive an investment as you can make.
If you're like me, you understand that investing is important, and your goal is to invest as much as possible so that one day you can retire rich and give your boss the middle finger you've been waiting to give them. Especially if you're your own boss and you work 80 hours a week, or you have a side hustle to make extra money. Often though, the problem we all share is that we're conflicted. We have some money saved, but we're not sure what to do with it. Do we pay off debt? Do we invest? Do we wait for the market to drop? Do we give our money to some fund manager who'll say they'll make lots more money with it? These are the questions in our heads. And at the same time, you hear your friends talk about how they invested in something like Beyond Meat or got lucky on some other hot stock and recently made a killing. And all it does is leave us feeling bad because we didn't invest. Then the classic feeling of FOMO sets in, and now basically we feel like it's too late to even start investing because the market already shot up, and so what do? We hope for the market to crash and it doesn't happen, so we end up pouring ourselves another sad glass of wine and we watch Bachelorette with our girlfriend or pwn some noobs in Halo. That is, you don't do anything at all with your money. Now, having read Warren Buffett's biography multiple times, I highly encourage you to read it as well. You can either read it in print or you can audiobook it. I've got an Amazon link for you below. And I found there were two main principles that really sort of guided Warren Buffett's investing career. Regularly invest for the long term in what you know. 2, buy undervalued assets. The problem is, how do we know what is good to invest in for the long term? And the second problem is, how do we buy undervalued assets? Well, I will tell you exactly how to do both of those in this video. And in order to do this appropriately, we are going to break this down into 3 chapters. Chapter 1, what to do over the next 60 minutes after you click out of this video. Harvard did a research study and found that if you have $1 in your checking account, that is in your main account where you get paid, you are nearly 100% likely to spend that $1. However, if you transfer that $1 to what you consider to be an investment account, be it a retirement account or some kind of other investment account or even a savings account, the likelihood of you spending that same $1 is close to 0%. This evidence is so stark that simply by moving your money, you're going to make big money. And that's where we're going to get into the 5 baby steps. And unlike some other baby steps you might be used to, this time we're actually gonna be able to graduate to like toddler and adult, okay? Baby step number 1, you're going to go to wealthfront.com and you're going to open a high interest savings account. What's crazy about this account is it has absolutely no fees to set up, no fees once you have it, no fees to transfer money around. They literally pay you money and insure it with 4 times the normal FDIC insurance limit. And you're going to park your money there and they will pay you 2.5%. just to leave your money in an insured savings account. It's literally like getting paid for doing absolutely nothing with no risk. And don't just think it matches inflation either, because right now inflation is like 1.6%. Well, they're almost paying you 1% more than that, 2.57%. It's crazy. You're making money over inflation, saving money in a risk-free asset. Now, I know I might be sounding like I'm fanboying a little bit, and maybe I am. I just want to be very clear, this is not a sponsored video. I'm totally doing this because I have probably logged into my Wealthfront account like 30 times over the last 2 days. I've been stuck in this little room researching everything possible about them, and I'm super excited to bring you this because when you get through this video, you're just gonna be like, oh my gosh, like this is A, relatable to exactly why I'm not investing, and B, this solves it. It's like, now, once you get excited to actually start doing this, go ahead and start with, getting your feet wet. Transfer a smaller number than you eventually want to transfer. In my case, I just transferred $1,000 just to kind of get a feel for how everything was, kind of get my feet wet, get comfortable with the paperwork and the disclosures a little bit more. And eventually, what'll probably happen is the same thing that happened to me, and you kind of start getting convinced like, oh my gosh, I'm gonna start moving all of my money over here. See, let's make an example. If I take 10 rental properties and I have separate bank accounts for each of them, and each of those bank accounts has like $10,000 just in case like the roof goes out or a furnace needs to be replaced or whatever happens with those rental properties, that money is basically losing me money sitting there thanks to inflation. But if I just move that all over to Wealthfront, it'll actually make me 2.57%, which is $257 per year per property in basically extra cash flow. I'm like, oh, why am I not doing this already? In other words, this would be a great place to park your emergency fund as well. Baby step number 3, I want you to automate your transfers. Every single time you get paid, ask yourself, what can you save? Pick a number and have it automatically transfer. Now, I definitely recommend you don't skip this step. Start with some kind of automated transfer, even if it's just like $10 or $20 every single time you get paid. What's gonna happen is you're psychologically going to start seeing that number grow in your Wealthfront account, and you're gonna get motivated to start trying to figure out how can I increase this automation and start doing it more and regularly. So get in the habit of moving the money over to Wealthfront, and then I'm gonna show you exactly how to milk it like Warren Buffett would. All right, baby step number 4. I know this sounds basic, but research shows that most of us don't know what all of our subscriptions are and all of our debts are. So please do this baby step 4. Take a piece of paper right now, even if it's just a Post-it note, write down all the debts you can think of off the top of your head, all of your subscriptions that you pay money for every single month. See what subscriptions you can cut out. You'd be surprised. I bet you every single person watching this video is like, wow, I totally forgot I was still paying for whitepages.com. And then don't fall victim to what Harvard says most people do. Do not pay off your debt in equal amounts or whatever has the smallest balance first. Please make the financially wise choice and pay off whatever the highest interest rate is that you have first. Baby step number 5. I want you to go to the tab at the top that says Open New Account. And this time, instead of a high interest cash savings account, I want you to press the General Long-Term Investing button. Now, 2 things. If you like Vanguard, you're going to love what you hear in this video about Wealthfront. So hold your horses, Vanguard fans, you're going to love this, I promise you. The second thing is don't set up any automated transfers just yet. We gotta come up with a plan first, and then we're gonna take care of what to do. Holy smokes, the 5 Meet Kevin baby steps are, well, actually pretty dang easy. So think about those. Remember, you're gonna do those in the 60 minutes after you watch this video. Not a sponsored video, but keep watching because I wanna get to the Warren Buffett investing methods and how you're really going to extrapolate your wealth pretty much automatically. This is gonna be really fun. Here we go. Chapter 2, what to do over the next 6 months. Now, going back to that Harvard research from earlier, we find that most investors spread their risk too little. That is, they don't diversify enough. And because of that, there are more sharp ups and sharp downs, which lead to more emotions and more of a likelihood that you're going to make a mistake. So we're going to try to prevent that by making sure we spread our investments correctly into what we're familiar with and for the long term. Here's how we're gonna do that. And don't worry, Warren Buffett's buy below market value assets part is coming, I promise, stay tuned. Well, enter index funds and Vanguard. I'm sure you've heard of these before, but don't worry if you haven't. Here's a really quick primer. When you buy a stock, you buy a slice of all that company's profits and losses, but that means you have to pick a company you believe in, which is hard, and Warren Buffett says we'll probably fail at that, at least at first. An index fund is a way to buy a slice of an entire sector. Think of it like a slice of a basket of companies. For example, a really popular set of index funds are Vanguard's total stock market index funds, which basically track the entire United States economy. So now instead of buying a slice of one company, you buy a slice of the entire US economy or international economy, or a slice of whatever basket you want to track. Enter Wealthfront's investment account, where Wealthfront automatically, for you, wait for it, invests into different Vanguard index funds for you. So it's kind of like each index fund is its own basket, and then Wealthfront came around and put its favorite into a bigger basket, and now you're buying into a slice of the bigger, diversified basket. Now, just to clarify, Wealthfront will spread your money into things like Vanguard's Total Stock Market Index Fund, Vanguard's Emerging Markets Fund, Vanguard's Dividend Fund, Vanguard's Real Estate Fund, Vanguard's Bond Market Fund, and some others. Basically, Wealthfront is like the index fund of index funds, and it does it all automatically for you. I now want you to pick a percentage of your high yield savings that every week you're going to move over into this investment account. So for example, let's say every week you put $200 into your savings account. Well, maybe you automatically take $100 of that and automatically have that go into the investment account so it gets invested automatically. Now all of a sudden, literally, you're doing absolutely nothing. You go to your job, you get paid, a certain portion goes into your high yield savings account, a certain portion of that goes over into your investment account, and now you're growing both your savings account and your investment account at the same time, like, you don't have to do anything. Now, some of you might be asking, wait a minute, there has to be a fee for this. This sounds way too good to be true. This is like, sounds really awesome, and I'm signing up for the account right now. Well, don't do that yet, wait. Yes, Wealthfront charges you 0.25% of the assets that you have in your investment account. So if you have $5,000 in your savings account, that doesn't cost you any money. They're paying you 2.57% on that. Well, if you have $5,000 in your investment account, they're going to charge you 0.25%. That works out to about $12.50. However, if you go down to the link in the description, right at the top, you're gonna see my Wealthfront referral link. You are going to get your first $5,000 managed for free. I'm not sure when this expires, but I believe that means you save $12.50 every single year on your first $5,000 that you invest. Now, here's the cool thing about this. Once you sign up using this link and you get in and you get established and everything, you're also going to get your own referral link. So now let's say you invite your parents or your friends, and don't worry, it's not like an MLM or whatever, it's just a way to reduce fees and for them to get more business, right? You invite your friends or your parents or whatever. Let's say you invite 5 other people. That means you used my referral code, you invited 5 other people, you can now get 6 times 5 or $30,000 managed completely for free. That's like saving $75 every year. It's kind of cool. Now, just to be clear, Vanguard is still going to charge their portfolio management fees. So for example, if Wealthfront takes your money and invests it into the Vanguard Total Stock Market Index Fund, you're still going to be paying 0.03% to Vanguard. But if you use and share the referral code, you'll be able to minimize what you actually pay to Wealthfront. Chapter 3, what to do over the next 2 years and beyond. Whew, I had to go get some water. See, by this point, I have to say congratulations. 50% of people have probably, at least statistically according to the YouTube algorithm, not smashed the like button and already left the video, and they're gonna miss out on the best part. Warren Buffett, how to buy below market value assets. So now we've identified what you're going to invest in. You're basically investing in this basket of baskets that cover the US economy and global economy and real estate and some other parts. But what does Warren Buffett want us to do now? Well, for most people, we don't have to do anything else. We could literally stop at chapter 2 and call it a day. The problem is there are people like me in the world who want a good deal and want to buy under market value assets and want to catapult our wealth. So if you haven't yet researched Warren Buffett or some of his investing principles, let me tell you another big thing that he likes to invest in are things known as cigar butt stocks or cigar butt companies. And basically, cigar butts are companies that have fallen out of favor with the marketplace. But Warren was able to do some quick math on some financial reports and realize, wow, okay, these companies are actually selling at a value that's lower than what all of the company's assets are worth. Think about it like this way. If the market says a company's worth $500 million, but they have a factory worth $1 billion, it means they're trading for a 50% discount. And that discount, whatever percentage it ends up being, is what Warren Buffett calls his margin of safety. So all of the principles in here really relate to how Warren Buffett recommends you invest for the future, but also goes back and sees, well, how did Warren do it in the past, and how can we still do that today? And I'm gonna show you exactly how to do that. See, unfortunately, a margin of safety in stocks is very difficult because stocks are basically internationally competitive. This is where real estate comes in.
If anybody is thinking about buying homes, 5 years ago they couldn't buy them fast enough because they thought they were going to go up, and now they don't buy them because they think they're going to go down, and interest rates are far lower. It's a way, in effect, to short the dollar, because you can take a 30-year mortgage, and if it turns out your interest rate's too high next week, you refinance lower, and if it turns out it's too low, the other guy's stuck with it for 30 years.
Now, Warren recommends initially that you should buy something that a handyman would be interested in.
If you are a young individual investor at home and you have your choice between buying your first home or investing in stocks, where would you tell someone is the better bet?
If I thought I was going to live, if I knew where I was going to want to live the next 5 or 10 years, I would buy a home and I'd finance it with a 30-year mortgage, and it's a terrific deal. And if I was an investor that was a handy type, which I'm not, and I could buy a couple of them at distressed prices and find renters, I think that's, and again, take a 30-year mortgage.
And just to be fully transparent, I've been a real estate broker now for almost 10 years, and I've represented hundreds of clients buying and selling real estate. And I've identified something I call wedge deals. These are basically properties that are very similar to Warren Buffett's cigar butt stocks, yet in my search for cigar butt stocks, I find very few. But in my search for wedge deals in real estate, I still find a lot. The reason for this is simple. There's not an international community of buyers competing for real estate like there are stocks. So you can take these same Warren Buffett principles and apply them to wedge deals. So what are wedge deals? Well, there are 3 types of wedge deals, but I'm just gonna keep it simple. I'm gonna talk about the most common type of wedge deal. The most common type of wedge deal is when you buy an apartment building or you buy a house where it's stinky, it's dilapidated, the wood is rotten on the outside, and things don't look that good. They feel kind of nasty. But it's a property where the previous owner or the current seller has fixed up things like dual pane windows, copper plumbing, a newer roof, the foundation's good. All of the really expensive things are good, and all of the cheap stuff like paint, carpet, and termite repairs on the outside boards are not done. They're left for you. Well, those properties usually sell for significantly under market value compared to the cost it actually takes to bring them to their true value. That's why we call it a wedge, because of that difference. The wedge ends up being your profit. And see, that's something index funds can't do. Index funds can help you build your wealth pretty dramatically. Now, it's also helpful to buy real estate that will cash flow when it comes time to rent it out, but more on that in another video. In fact, if any of this is confusing to you at all, don't worry about it. It can get a little bit exhausting and overwhelming. But that is also why I have a real estate investing course where I have over 340 lectures, over 45 hours, teaching you everything I know about real estate for a pretty small cost. I mean, there are a lot of courses out there that are really, really expensive. This is very inexpensive for what you get. And in case that's not enough, I also do private live streams twice a week where I help people fill in the gaps, I answer questions, and I help analyze people's deals. I also have a course for real estate agents if you happen to be a real estate agent as well, but that's separate. And I do in-person real estate crash course events because I believe in this so much. In fact, you can meet me at Chicago next, and then Austin and Seattle are after that. But now what I really want to do is show you how amazing Chapter 2 is, why it's so great, and how it's going to create this massive war chest for you for when it comes time to buying Warren Buffett, the low market deals. Under the financial independence subreddit on Reddit, I found this thread which was getting a lot of upvotes, over 3.9 thousand. And I found out by messaging the creator of this that first of all, he let me go ahead and use his infographic, but he also has a YouTube channel. Looks like he's just starting out, so we're gonna go ahead and hit subscribe, hit that notification bell. So the infographic is pretty simple. You've got Tiffany, Brittany, and Sarah, and each of them save $200 per month and invest it in different strategies over the next 40 years. So remember, we're just talking about $200 per month. And the index fund that they're choosing to invest in is an S&P, basically total stock market index fund of the S&P 500. You don't really have to know what that is. It's just a lot of stocks. It's a popular index fund. So here we go. On the infographic, we see that some major market crashes are plotted, which becomes important because when we go down to Tiffany, we find out that Tiffany invests her $200 per month in a savings account, earning 3% per year, waiting for the perfect times to invest. Problem is, she ends up having the worst timing and she always invests at the top of the market. But she never sold. She always held on to her money, which is exactly what you should do with the Wealthfront account as well. But even with her terrible timing, her $96,000 turned into $663,000. So even though she bought at the absolute worst possible time, she still turned her $200 per month into $663,000 because she never sold. That's actually pretty inspiring. That makes me feel better about buying Tesla at certain times. Then there's Brittany, and she got lucky and ended up always buying literally at the market bottom every single time. So obviously we think she's going to have more money than Tiffany that had, $663,000. And this would be correct. She has almost $1 million, automatically putting $200 every single month into her savings account, and then at the bottom of the market, putting it into the S&P 500 index fund. Well, then comes along slow and steady Sarah, which you can see here by her face that she is kind of clueless, which is kind of cool because maybe she's clueless because she likes things being really simple, kind of like I do. I like simple. And she doesn't really give an F what the market's doing. She just literally puts her $200 per month directly into that index fund, which you could also do that with the Wealthfront. I just recommend that you make that pit stop and put it all into the savings account first, so that way you got an emergency fund, and then you slowly put it into your investment fund. Anyway, Sarah here says, I'm gonna put $200 per month automatically into an index fund and never look at that account again. Well, just to remember here, Tiffany, who bought at the top of the market all the time, had $663,000. Brittany, who buys at bottom, almost had $1 million. Slow and steady Sarah, who didn't care if it was the top or bottom of the market, always bought, ended up with almost $1.4 million. That's crazy, and to me, it's a real testament to how powerful just regularly investing is. The point of this whole video, though, is you can see you can build a pretty massive net worth just by doing things automatically. And you may as well save the money at every step of the way. You may as well have the high yield savings account. It's the highest yielding savings account that I was able to find right now. And it's the one that has no fees, at least that I could see. Now, obviously their goal is to get you to put some money into their investment services, but their investment services are actually kind of cool. I mean, now I don't have to pick individual Vanguard funds. They just automatically do that for me, which is awesome. So what do you have now? You're saving automatically, you're investing automatically. As these balances grow, what are you going to do? You're going to take that money and do nothing, or you dump it into cigar butt real estate. Remember, check out the real estate investing course linked below. Feel free to join me at one of my one-day crash courses, just so you know how those are different. The online course is 45 hours of content plus the live streams. The crash course is like 7 to 8 hours in person, so there's only so much we can cover, but it'll really get your gears going for real estate and hopefully eliminate some of the fears that you might have for real estate. In the meantime, still sign up for Wealthfront, and I have a feeling if you just follow chapter 1 and 2, you'll be totally fine. If you follow 1, 2, and 3, you'll be great, and you'll be on your way like Warren Buffett in the modern world. Thank you so much for watching. Keep in mind you can follow me on Instagram as well. The easiest way to reach out to me is either on our private Discord services if you are a course member, or you can send me a message on Instagram, which eventually I'll get back to you. Thank you so much, and now get started with that 60-minute challenge. Go do chapter 1. Open that savings account, get all your information in there, and start getting that auto draft set up. Then you'll be on the ride. We'll see you in chapter 3.